In 1988, Warren Buffett penned a letter to his shareholders that has since become required reading for any serious investor. Today, we're going to decode it. This isn't just about history. It's a timeless playbook for how to think like a true business owner, not just someone who trades stocks.
So in '88, Berkshire's net worth grew by an impressive 20%. A great headline number, right? But the very first thing Buffett did was tell his investors to look past it. Why? Because that headline figure, the accounting number, isn't the real story. And this is where he draws a huge line in the sand. He makes this critical distinction between book value and what he calls intrinsic business value. You see, book value is just an accounting figure. It's about the past. But intrinsic value, that's an estimate of the true underlying worth. It's all about the future cash a business will generate. One is just an accounting exercise. The other, as he says, is the real prize.
All right, let's dive into this masterclass. We're going to break down his thinking into 5 key themes. First, looking beyond the standard accounting numbers. Then, what he calls the saints of business. Third, his famous forever holding period. Fourth, how he exploited market irrationality through arbitrage. And finally, we'll wrap it all up with the owner's mindset. Okay, first up, Buffett throws down the gauntlet and challenges the very idea that accounting numbers equal truth. He argues that the standard rules, generally accepted accounting principles, or GAAP, can often hide what's really going on in a business.
He tells this brilliant story about an accountant who, when asked what's 2 plus 2, just replies, "What number did you have in mind?" It's a sharp, kind of funny reminder that accounting isn't absolute truth. It's a representation, and it can be shaped. The warning here is crystal clear. Never, ever blindly trust the reported earnings.
So, for Buffett, financial statements aren't the answer. They're actually the beginning of your homework. He uses them as a tool to ask these 3 much deeper questions that get to the heart of a business's real value, its stability, and the quality of its leadership.
So if the accounting numbers can be misleading, what can an investor really trust? Well, Buffett's answer is pretty simple: real, tangible, durable value. And you don't find that value in a spreadsheet. It's created by exceptional businesses that are run by exceptional people.
And get this, his core operating businesses, the ones he called his Sainted 7, generated an average return on equity of 67%. Now, the absolutely stunning part? They did it with 0 debt. This wasn't some kind of financial engineering. This was pure operational excellence. It's the sign of a business with a competitive moat so wide it just gushes cash. It's the ultimate economic engine.
I mean, this has to be the ultimate compliment, right? When a really smart, successful competitor like William Dillard basically says, "Nope, we're not even going to try to compete with you. You know you've built something incredibly powerful and durable." And the source of that incredible power wasn't some complex business school strategy. It was this simple creed from Rose Blumkin, the founder of Nebraska Furniture Mart. This fanatical focus on the customer is the absolute bedrock of these saintly businesses.
And this right here, this illustrates the other key ingredient perfectly: the integrity of the management. This was literally his logic for buying Borsheim's jewelry store. He didn't even need to audit their inventory because he trusted the people. For Buffett, character is the most critical asset on the balance sheet.
Okay, so you've managed to find one of these truly great businesses. How should you invest in it? Well, this is where Buffett says you have to apply that exact same business owner mindset to the stock market. It's not just what you buy, it's how you own it.
This is probably one of Buffett's most famous lines ever, and it really is the heart of his entire philosophy. He's not renting stocks, he's not betting on what the market's going to do next week. He is buying pieces of excellent businesses with the full intention of holding on to them for the long haul, just like a private owner would.
He uses this fantastic analogy to describe the completely backwards behavior of most investors. They rush to sell their winners, cutting the flowers to lock in a small gain. Meanwhile, they hold on to their losers for dear life, watering the weeds, hoping they'll somehow come back. It's the exact opposite of what any smart business owner would ever do. So, if great management is so key to this forever idea, why is it so hard to find? Buffett gives this brutally honest take on corporate America. Unlike most jobs, a CEO's performance is often measured by fuzzy standards, if at all. And the board of directors, who are supposed to hold them accountable, they're often too friendly to be effective. This is what makes truly great leadership so incredibly rare and so valuable. Holding forever takes immense patience. But what does a smart investor do while they're waiting for that perfect company at the perfect price? Well, for Buffett, one answer was something called risk arbitrage, a strategy for cashing in on short-term weirdness in the market.
Now, Buffett is really precise here. This is not speculation. Risk arbitrage is a specific, probability-based bet on announced corporate events, like a merger. You're not betting on where the market's going, you're betting on whether or not a specific deal will close.
And of course, he has a playbook for it. For any arbitrage situation, he boils it down to these 4 critical questions. It's just a clear, rational framework to size up the odds, the timeline, the potential upside, and, most importantly, what happens if you're wrong.
The Arcata deal is a perfect case study of this in action. I mean, this thing was messy. The deal got delayed, the price got cut, a new bidder showed up. It required a ton of patience and a cool head. But by sticking to his framework, Buffett not only made a solid return up front, but he ended up with a huge, unexpected payday years later from a forgotten legal claim.
And here Buffett delivers the knockout punch to the efficient market theory. The data just speaks for itself. Over 63 years, $1,000 in the general market becomes about $400,000. Not bad. But by applying these principles of value and arbitrage, that same $1,000 becomes $97 million. It's just powerful real-world proof that markets are not always rational and a disciplined approach can win.
Okay, let's pull all these threads together now. This is where all those lessons we've talked about get boiled down into Buffett's actual actionable checklist for buying an entire business. This is the owner's mindset codified.
And here it is, his famous 6-point test. Notice how it reflects everything we've just discussed. He wants demonstrated earning power, not some hockey stick projection. He wants good returns without debt. That's the sign of a saintly business. And he requires management to already be in place because he knows that's where the real long-term value comes from. It's a masterclass in discipline.
He ends the letter by making his goal totally unambiguously clear. He is not managing a stock for traders. He is leading a partnership for owners. He wants shareholders who think like he does, who are in it for the long haul, and who measure success by the actual progress of the businesses they own.
And this really brings us to the final, critical question that Buffett's entire philosophy poses to every single one of us. In a world that screams at us to trade constantly and think in the short term, this 1988 playbook forces us to look in the mirror and ask, are we just renting our investments? Or are we truly thinking and acting like owners?